Hi, I'm Sherman Joseph with Fitzgerald Financial TowneBank Mortgage. It's a pleasure to be here this evening for our four-part series on home ownership and Mortgage 101 with everything you want to know about credit with Sean Higgins. It's very important that you sit in and ask as many questions as you would like. Sean and I have been doing these virtual events and in-person events for over 16 years now. And there would be nobody better at talking about credit and giving expert advice on how to raise your credit score and how to get to your destination. So, what we'll do this evening, we'll have Sean do his piece, and then it's going to be about a 20-minute presentation on everything you want to know about your FICO score. And then I will come in and do about approximately 35 minutes, and you're welcome to ask questions at any time. And I will do a presentation on Mortgage 101. And we hope that by the time we leave you, you're ready to purchase a home. Certainly, you're welcome to call me, and I will guide you through the process and make it as seamless as possible. But the journey starts with getting pre-qualified and understanding everything about your credit. So without further ado, Sean Higgins from United One.
Thanks, Shervin. Good evening, everybody. Thanks for participating. We really look forward to imparting some knowledge on credit scoring and mortgages. So my name is Sean Higgins. I'm from United One Resources. We are a credit reporting agency. We sell credit reports to lenders such as Fitzgerald Financial, TowneBank Mortgage that Shervin works with. Shervin and I have a long-standing relationship. We've provided these presentations for a number of years right now. My contact information is listed. One thing I'd like to establish right up front is that we are not a credit repair company. Shervin will get really deep on the credit repair a little bit when he's doing his presentation, but we work directly with lenders. We help lenders gain score improvement for their clients, and that's our role. But I just like to make sure I'm very clear right up front that we are not in the credit repair business. So I'm going to take you through a little bit of a journey on the credit reporting business and how the scores work and how they can be improved and those types of things. So credit scoring. So what is credit scoring? Credit scoring is one of the most important factors when it comes to getting a mortgage. A credit score, by definition, is a measurement of the risk of default by the borrower. Basically, what it means is it's a score that's appended to your credit file that's going to give a lender an indication of how well you pay your bills and the likelihood that there will not be a default. In mortgage credit reporting, right now, we use a FICO score version 8. There's a lot of different scores out there, which I'll touch on a little bit deeper, but it's FICO score version 8. Most people have a credit report with one of the three major credit bureaus, TransUnion, Experian, and Equifax, and they maintain your credit files, and the score gets appended. The best way to describe a credit score, it's almost like a stopwatch after you've just finished running. At that moment in time, when your credit report is accessed, you'll see a credit score is appended. It's right then and there. The three national credit reporting bureaus, TransUnion, Equifax, and Experian, maintain credit files. They're usually pretty consistent in the file content. They're not very consistent as far as the timing of the reporting. So I'll talk a little bit about that as we get further into this. You're also going to hear me talk a little bit about credit fitness. It's a term that we use in this presentation that what we like to impart upon people is get to know what's going on in your credit file. Be aware of the content that's in there because there is some erroneous information that does exist in credit files. So you hear me talk a little bit about credit fitness as we move through this. So what are the credit score ranges? They range from 350 to 850, I believe. And most credit scores that we see in our world are in the 580 and above. Less than 580, there's a small percentage of them that are out there. And then all the way on the other side, I think the greatest credit score that I ever saw was about an 820. There's not a lot of those people walking around. And where we fit into this whole process is we work with the lender to sell them the credit report with a score. And then we look for ways to improve the scores. We have a score simulator that helps with the actions that need to be taken in order to improve the credit score. Okay. A lot of questions around what actually impacts a credit score. And there's really two things that really have a significant impact on your credit score. First one, and the largest one, is how well you pay your bills. That's about 35% of the score content. The next one is 30%, and that's considered to be amounts owed. And amounts owed are also known as utilization. They're also known as balance to limit. Plain and simple, what that means is if you have $1,000 credit limit and you have a $100 balance, that means you have about a 10% utilization. So that utilization, or also known as amounts owed, has about a 30% weight on your credit score. The three other factors that are listed are new credit, not so much of an impact on that. The length of the credit history, that can have an impact on your credit score. And then also the credit mix is a little bit less important. I'm going to talk a little deeper on these topics, but the two things to focus on is try to pay your bills on time and keep that balance to the limit below 20 to 30%, and you'll maximize your credit score. Okay. So let's start at the top. What's an inquiry? So an inquiry is when you allow someone to pull your credit report. There are two types of inquiries. There's a hard inquiry, which usually follows a application for credit. The consumer has to approve the access of the credit file, and that's considered to be a hard inquiry. A soft inquiry is an inquiry that's done in an existing account for a review purpose, and it's also used for pre-approved offers of credit. Soft inquiries do not have an impact on your credit score. Hard inquiries do. We get a lot of questions on how much a credit inquiry will impact a credit score. There's a lot of misinformation that exists right now out there because there's a lot of knowledge about credit reporting that's out there. There's a lot of opinion pieces that are out there on the internet. But the rule of thumb is, and I've seen this thousands and thousands of times play out, if you make a credit report inquiry, if an inquiry is made into your credit report, I should say, 30 days after that report was accessed, your score will go down by about 5 points. It's not a big deal, but that's usually what it is. Sometimes I get questions about, what if I go out and apply for multiple providers for a car or a mortgage or whatever it may be? And the nice thing about that is that those inquiries are all considered to be the same because they're coming from the same type of an industry. And if they're within a 30-day focus period, it's not going to have any greater impact on your score. So the most important thing to remember about your credit score is after a hard inquiry, it's 5 points and it's 30 days. There really shouldn't be any fear in having your credit report pulled because when you actually work with a sharp lender like Shervin, you're going to find out that you really can't do a whole lot without a credit report, a hard inquiry, and that's the best place to start. Okay. So people always ask, how do I improve my credit score? It's pretty simple. Pay your bills on time, keep those balances low on the credit cards. The revolving credit, which is also known as credit cards, that's the one factor that has the biggest impact on your credit score. And as far as your balances, and the reason for that is because that's a very unpredictable amount that you're going to owe every month. If you had an installment loan that has a predictable monthly payment, that's not as big of a score factor as the revolving credit because there's going to be different points in your life throughout the year that you're going to have a need to use your credit card or maybe not use your credit card. Okay. So let's talk about that credit fitness that I brought up before. Every consumer in the United States can get a copy of their credit report for free every week through annualcreditreport.com. Annualcreditreport.com is a great place to understand what's going on with your credit report, and it's free, and it's a great place to learn and to get involved in the credit fitness that you hear me talk about throughout this presentation. What are the 5 things that really drive your scores down? It's anything with the current, past due, anything that's recently late, high balances. I looked at a credit report for a lender today, and the consumer had a 100% utilization, which means that if they had $1,000 limit on their credit card, they had $1,000 balance. So really that's going to work against your credit score. Any public record information that might be derogatory. And quite honestly, if you don't have a lot of open or active trade, that's going to have a bit of an issue on your credit score as well. Okay. So what are 5 ways that you can improve your credit score? This is the one that we see a lot of. We see a lot of individuals that may have a recent late through maybe no fault of their own, a mistake, whatever you want to say. If you have a one-time late and you have a seasoned account, which means that you've been current all the time and you've been with this particular credit grantor for a long time, there's an opportunity to get a one-time courtesy removal. It's just a matter of asking for it. We see collection accounts out there, and collection agencies, they're salespeople and they want to get paid. And quite honestly, if you could get a collection account paid and removed from your credit report, that's probably worth about 50 or 60 points to your credit score. Negatively, when it gets placed on your credit report, it's going to have a deduction of about 50 or 60. So that'll actually improve your credit score. Revolving debt, let's keep those balances below 20%, as I've talked about. Student loans, we see a lot of people with student loans that have a deferment. And when they're in deferment, sometimes they're not reported properly by the servicer. And when the servicer is not reporting them properly, it's going to have a negative impact on the credit score if they're being reported as late. Installment loans, there's literally no benefit to paying off an installment loan to your credit score. The reason is because of predictable payment. Sure, and we have a question here. It says, how do the current interest rates impact my ability to buy or sell right now? If you want to touch on that right now. Shervin?
With a great job market, did you hear me? Were they able to hear me?
No, sir.
Oh, okay. So interest rates, as we know, are higher right now than they've been in some time. And that's mostly attributed to the debt ceiling, the war in Ukraine, the hint of inflation, and so forth. However, that does impact some folks, because if you're borderline on qualifying for a specific amount of property, then again, you have to get with a loan officer to see what you qualify with these new rates. Because if you qualified a year ago, you might have qualified for a different amount of property because the rates were lower. Now that the rates are higher, and they're not really and truly, traditionally, they're not high. If you go pre-pandemic, and I mean like 2 years before the pandemic, the normal would have been about a 5%, 6% interest rate, which is pretty much where we are right now. Right now, we're around low sixes for a government loan, which is FHA, VA, and for a conventional loan, about 6.5 to 6 3/4. Now, keep in mind that if you're qualified, you should always buy. Paying somebody else's mortgage and renting is not really the right option, because I could take you back in time, and in the 80s and 90s, you're talking about double-digit interest rates, and there was kind of a boon on buying then. So if you're capable of buying, you'll be able to refinance in a couple of years. We're expecting a refinance boom, and it's all speculatory around 2024. However, it does have an impact, but the onus is on you to ensure you're in position to buy a home by at least contacting the loan officer, getting pre-qualified, seeing where your credit is at, and what you have to do from an asset standpoint and from an income standpoint, how that's going to depend on your qualifications. And lastly, keep in mind when people say, well, I'll just continue renting. Well, you're not establishing any security. You're not establishing any equity. You're just paying somebody else's mortgage. And it's the same thing you're doing. The only difference is you're paying someone else's mortgage and you're not owning. So don't let the rates, which is really, and I don't want to sound like, you know, just talking in vain here, but the rates aren't really high in a traditional market. It's high because during the pandemic, we got a little accustomed to the rates being lower. So hopefully that answers the question. Sean.
Thanks, Reverend. Yeah, and the most important thing that he said there too is you have to start with the lender. That's where we get involved. That's where a lot of things really start to show up, and everybody understands what's going on. Thanks, Sherman. So let's talk about credit scores real quick. So I've been doing this for 31 years now, and when I got in this business, no one really understood credit scoring. Now, a lot of people do, and there's great tools out there. There's the Credit Karma score. I think there's well over 100 million people that use Credit Karma. It's a great, great tool. However, there's a difference in the credit score that's going to be presented in the mortgage space versus the Credit Karma. They're just two different models. The file content is a little bit different, and the score factors are different. The most important thing to remember is if you have a Credit Karma account, that score is usually going to perform about 30 points greater than the score that they use in mortgage. So, for instance, if you're a 780 in Credit Karma, in their score, which is called the Vantage score, you're probably going to be a 750 in the mortgage score. Both great scores, but there's a difference. There's a difference in the way that they're calculated. And the thing that I like to stress the most in this opportunity to speak to people is 30 points is generally speaking what the difference is going to be. Okay. There's a couple of credit tools that are out there that people have become aware of in the mainstream right now. There's a product called Experian Boost, great tool for helping people build credit. However, it's not anything that's going to be used in the mortgage space. And as a matter of fact, it could become problematic in the mortgage space because what often will happen is that Experian Boost trade line may get in the way with the lender. It's not considered in the score, and it's some stuff that can clutter up your credit report when it comes to mortgage lending. Rental information, a little bit over almost 2 years ago, there was some talk about rental information being considered in credit reporting. Rental information is very, very important in the mortgage process. However, any rental information that's contributed to a credit report is not going to make its way onto the credit score. So that's the most important thing to remember about that. Medical collections, this is a big deal. One of the worst drags on a credit score in the past had been a paid medical collection. It just became very, very problematic. So just about a year ago, the three national credit reporting agencies decided that they were not going to report paid medical collections anymore. And so that's helped people's credit scores improve by 30, 60, 90 points, depending on how many of them were. Also, at the end, in July of last year, any unpaid medical collection debt had to wait for an aging of 1 year instead of the prior 6 months. And the reason is because it gives people an opportunity to clean up any balances they may have with the collection agency. And then also in the beginning of this year, any medical collection that was under $500 was not going to be reported, because I can't tell you how many times we would see credit reports with $82 balance collections that were harming the score 60, 70 points. And quite honestly, they were only placed on the credit report so that the consumer would have a real reason to make a payment. So that's gotten cleaned up a lot. People are being viewed in a much better light. Medical collections happen. They can be cleaned up, but once they're paid, they're off the credit report. The time reporting period has been extended from 6 months to a year, and they have to be at least $500 to make its way on a credit report. Okay. Leave you with this last. So here are the websites for each of the credit reporting agencies: Experian, Equifax, and TransUnion, along with their telephone numbers. Annualcreditreport.com, which I spent some time talking about a little bit earlier. That's very, very important. Get familiar with what's on your credit report. And then the last one is something that I spend a lot of time talking to lenders and consumers about. It's called opt-out pre-screen. Opt-out pre-screen is a great way to get those pre-approved offers out of your life, and from showing up in your mail every night and having people bother you and ask you to apply for credit when you don't need it. I mean, credit is available. You go to a great loan officer like Shervin, he'll send you down the right path. That'll also help you with regard to eliminating a real significant threat that I think of for identity fraud, so that we see a lot of people that have come through need help with their credit report, and their identity got compromised because someone reached in their mailbox and grabbed the pre-approved offer from Discover or whomever, and that's got to go away. It's really got to go away. So opt-out pre-screen, I think anybody I talk to, I say get involved in that, get your name off of that list, and just get away from the threat of identity theft and anybody else buying. That's all I really have for today. I'm glad to answer any questions as we move along and help any way I possibly can. Thank you.
Thanks, Sean. As usual, outstanding. Absolutely the best at credit information and credit disclosure. It is critical you understand that Sean is not a credit repair person. I'm not a big fan of credit repair because the dollars that you take to enhance your credit and pay someone else that says their credit repairs the same dollars that you could take and pay your bills down, pay your bills off, or even use towards a down payment. Because you could wind up paying folks thousands of dollars, depending on your situation. And it's just the same things that you could do. As a matter of fact, when you see me, I have a simulator, and it does a simulation on what your situation is, how to increase your score, what you have to do to pay down, pay off, etc. And I get that from Sean's company, and that's attached to the 3 reporting agencies. So pretty much you're getting the same thing for not the kind of cost. All right. So just a word to the wise. Just be careful with the credit repair shysters. Excuse me, I didn't mean that. And if they'll bring up my presentation, it'll be my pleasure to get started. First of all, I have been in the industry for about 37 years. I've held just about every title in the profession, from mortgage banker, mortgage originator, branch manager, area manager, division manager. My point is that I've pretty much seen it all, but I love being a loan officer. That's what I do. That's true to who we are. I'm also a diversity outreach manager for both TowneBank and for Fitzgerald Financial. So you'll see that Fitzgerald Financial Group is the entity that I work for. Our parent, our bank, I also work for TowneBank Mortgage, which Forbes magazine named us the number 9th performing bank in the U.S. Now, there's approximately, maybe more, maybe less, 5,000 banks in this country. And so when you're ranked number 9 by Forbes, you're doing something pretty darn good. And we're proud of TowneBank as we are Fitzgerald Financial. And so we're known to get things done and get them done pretty efficiently. And the reasons are, you ask yourself, why choose us? Well, we tailor-make loans for your needs. We give you personalized concierge service. And someone like myself will be your concierge. And I try to make sure that you get through in a seamless process. Competitive rates, we're very aggressive as far as rates are concerned. And we close on time. Matter of fact, we are known to have a pretty high benchmark. My team has closed loans in as little as 10 days, as fast as 10 days to 2 weeks as the norm. We know that other entities, other mortgage companies will try to compete with us. That's a tough challenge to accept because we do get loans closed pretty quickly. So if you're thinking about buying a home and you compare the options, renting, no control over rent increases, you have no tax deductions for rent, There's absolutely no privacy, and you're limited to the ability to personalize your home. If you're in a house or if you're renting an apartment, there's really no personalization there, and there's no reaping the benefits other than paying somebody else's mortgage. In other words, when you own, you build your own equity. You're going to have equity to buy the next house or develop security for you and your family. You have a tax deduction. There are loans that have zero down payment, which we'll get to that as the presentation goes along. You could customize your home and make it a home. Whether it's a backyard, whether it's pictures, colors in your different rooms in your house, and there are fixed rate options available for purchase. So you have to ask yourself, are you ready to buy a home? Do you have a steady income? Do you pay bills, including your rent, on time? Do you have low to medium debt? Do you owe do you do you owe any, or do you have any money in savings? And do you have the ability to make the mortgage payments? Do you have okay to good credit? So if you're answering these questions, where do you get the answers other than speaking to yourself? The realistic view and the best way to do that is the pre-approval process. Any real estate agent, before they show you a house, will want to know that you have been pre-approved by a loan officer, preferable a reputable loan officer. That is critical. Your team is critical to purchasing a home. So you have realistic pursuit of purchasing a property when you've been pre-approved. You strengthen your buying power. In other words, a realtor knows that you're capable of buying X amount of house. You don't want to go out and look at $500,000 homes when you only qualify for $350,000. Why are you at Neiman Marcus when you know that you can't afford Neiman Marcus? It's good to window shop, but it's not realistic. Understand the differences between what you could qualify for and what you really can afford. Understand the loan programs and how to use them to leverage your purchase. That is critical, because when you understand that there are programs out there and the different loan programs that could assist you, it won't be so daunting a process. It really shouldn't be a daunting process. I have people tell me all the time, I've heard horror stories. It's not supposed to be a horror story. If you're with the right team, the right person, you should be able to guide through. If you've done your homework and you've gotten pre-approved, you know already what the expectations are. So you can review your credit for accuracy before you start. Obtain a yes or a when answer to your loan application instead of just hypotheticals. So qualifying factors, the 4 C's: capacity, credit, capital, and collateral. Income, capacity to repay the debt based on your earnings and employment history, expenses, number of debts, and other obligations you have. Credit, history of how much you owe, how often you borrow, if you pay your bills on time, and if you're living within your means. Assets, capital, or the amount of cash you have for a down payment and settlement costs, as well as cash reserves to deal with repair, replacement expenses that may arise after you purchase a home. So many times we're so concerned about getting in the home, we're not as concerned with after we get in the home and being prepared to have reserves and set ourselves up so we have smooth sailing after our transition period. Property, collateral to protect the lender's investment if you can't repay your loan. The home you buy must be worth enough to back up your loan. So what factors affect your monthly payment? Well, obviously interest rates. You ask the lender for their current mortgage interest rates. Interest rates change daily and can change throughout the day depending on the market volatility. Right now, the market is fairly volatile with all that's going on in the world. And with rates rising a little, and then it'll ease back down, that's your volatility. But you're in connection with the lender, so they'll be able to explain everything to you. Ask the lender when you could lock in a rate to avoid increases in your payment. Typically, this can be done at the time you have a ratified contract. As soon as you have a ratified contract, my procedure from a protocol standpoint, I want to get you locked in and you don't have to think about it. It's there. We're not in Atlantic City or Las Vegas where we're playing the market. You want to make sure you're secure, you've got your rate, you're in good shape. And the idea is that we get you closed before your rate lock expires. Make sure your lock on your interest rate is locked until the day you close your loan. Origination and points or discount points are fees paid to the lender for the loan or can be linked to interest rate. Usually, the more points you pay, the lower the rate. Ask, for example, of payments with points and without. This will give you a better idea of paying points. Let me just give you a quick lesson on points. 1 point is 1% of your loan amount. So if your loan amount is $300,000, that's $3,000. I do not give points on loans. I try to get all my customers 0-point loans because that money you could use towards closing, you could use towards reserves for your house. Now, if you are in position where you want to buy down the rate and get a lower rate or so forth, I want to, I'll discuss that with you to see if it's economically worth it. Sometimes it's not really worth it to put all that money down just to say that you got to rate a quarter of a point less or half a point. It doesn't really move the needle of your mortgage payment. I see we have a question. Will housing prices in DC continue to rise? DC is a hot market. So I have to say that, yes, for right now, I would answer yes. Now, in answering yes, I'm saying for right now, in this climate that we're in, I haven't seen DC drop in the price in housing prices in some time. Even during the pandemic, it just kept on soaring. And that's because DC is just a great place to live. They've done a great job of the infrastructure and houses. Right now, the only issue and the concern, and that's, I don't want to say it's universal, but a lot of markets, it's inventory. Okay, but housing prices, for the most part, continue to increase, which, if you're purchasing a house, is something that you want, is that you want that appreciation. So, in getting back to what affects the mortgage payment, is lenders will typically require these items to be included in your monthly housing payment, which is homeowners insurance and property taxes. And usually we escrow form. So your payment could include your principal and interest, your taxes, and your insurance. Now, it's good that all of that is included. You have one payment and so forth. But if you didn't want your insurance included, you could certainly discuss that with your loan officer and see how you could get your insurance excluded. But usually if you have a government loan like an FHA or VA loan, it's usually mandatory that everything is included in the escrow. So which mortgage is right for you? Now, conventional loans start as little as 3% down. I caution you, you have to have excellent credit for 3% down. The norm for conventional is 5% down, okay? FHA is a government loan. By the way, let me back up. Conventional, just to let you know, is Fannie Mae and Freddie Mac. Those are the two governing conventional bodies that control conventional loans. FHA is the Federal Housing Administration. You get a little bit more latitude on FHA. It's 3.5% down. It'll give you more latitude on credit, and it'll give you more latitude on your debt to income ratio. That is the great instrument and probably the best instrument for a first-time home buyer. The renovation loan is to purchase a home with the cost and rehab. I am one of those mortgage bankers that believe that you should have some experience if you're going to do a renovation loan. I don't think you should be a first-time home buyer because it's a tedious process and it requires contractors, consultants, and so forth in order, and it's a longer process than just buying a turnkey where you turn the key and you walk into your house and you're ready to live. The USDA loan, great instrument, one of the best instruments and one of the best kept secrets. And while out there, it's said people think it's for the rural area. It is and it isn't. If you live around the Beltway, the Washington, D.C. Beltway, then this will just give you an idea. If Brandywine, they're USDA homes. That means USDA is 100% loan, no money down. So all you have to come to closing with is closing costs, and you're ready to close. Now, Waldorf, Akakeek, Malton, Upper Marlboro, La Plata. So it's out in the rural, but now more people have moved out in that direction. So it's not as far out as people think, but that's a great opportunity. Now, it's not just the subdivisions, it's not just the county, it's not just the city. Every house is determined to be whether it's USDA or not. It depends on the address. So you have to ask your agent, to ask the loan officer to look up the property and see if it's USDA approved, because there could be a row of properties on one side of the street approved for USDA, and on the other side of the street, it could be no approvals for USDA. You have to look up the address, ensure it's approved. And 9 times out of 10, if you have a really good agent, they would know from the listing agent if it's already USDA approved, because that's a good selling point. There's only 2 types of 100% loans. It's a USDA and a VA loan. I see we have a question. What is the criteria to access 100% loan? You have to have pretty decent credit for a USDA loan. You have to meet the income requirement, and the income requirement, frankly, isn't too low. So there's a lot of people that will qualify for it, but it includes a family of how many? And usually it includes all income in the household to apply for, to make sure that they've got everything covered. But it's a good loan if you qualify from a credit standpoint, and if you have the assets and your debt to income ratio, you're in good shape. But I do a lot of the USDA loans because I think it's a really good avenue for first-time home buyers. When you could get a property where you don't need the down payment, that will take care of a lot. The VA loan is the other 100%. If you serve your country and you have VA eligibility, you could also have no money down. And so in this particular case, there's no monthly mortgage insurance like there is with FHA or conventional. There's 2 types of insurance, let me just say. The insurance for protecting your home against anything happening to property, and the insurance to protect against something happening to the house for the for conventional or for FHA. In this particular case, USDA and VA, they have a fee, but it's not an exorbitant amount. The VA is a VA funding fee for veterans, and USDA is called a guaranteed fee, but it's amortized over the life of the loan, so you really don't feel it. We just discussed conventional, and now on conventional loans, let me go back. On conventional loans, if you're not putting down 20%, you will have what is called mortgage insurance, and that protects the lender against anything happening to the property, default, anything like that. And so if you don't put down 20%, you have mortgage insurance, and that is required. Now, with FHA, you also have mortgage insurance. Conventional mortgage insurance is called premium mortgage insurance. FHA mortgage insurance is called mortgage premium insurance. Their mortgage insurance just went down about 5 months ago, 6 months ago. It went down on the monthly factors. So that is really right now great opportunity. And just let me just give you a fact, fun fact here. Traditionally and throughout the industry, FHA and VA loans are going to be lower from an interest rate standpoint, and conventional is going to be higher. And the variance, the difference there is going to be about a half to 3/4 of a point different in interest rate. That's just the way it's been, and that's probably how it's going to continue to be. So right now, if you had your druthers, you want to take an FHA loan if you weren't putting down, 20%. Obviously, you put in 20% down, you eliminate mortgage insurance, and you go for the conventional loan. The VA loan, always the best bet for veterans. You need to capitalize and you serve your country, you put your life on the line. You need to go out and ensure that you're covered. And it's 100%. I'm a veteran. I'm a Marine Corps veteran. There is no reason that you shouldn't be in home ownership when you have VA eligibility. That means you could go out and get 100% loan. You could ask, doesn't mean the seller will do it. The seller could pay your closing costs. I've seen veterans go into home with no money out of pocket. Just saying, don't waste your eligibility. USDA loan, we just covered that. Great instrument. So a lot of people always call about grant funds because you hear about all the grant funds. Let me caution you with grant funds. I'm not cautioning you. Grant funds is a great thing. We have every grant fund access there is. However, grant funds is, in order to qualify for it, you have to have your debt to income ratio has to be a 45. Dead stop. No ifs, ands, or buts. The state of Maryland will not budge on that. And the difference is we could go up to about 50. They go to about 45. The great thing with the MMP program, and it's the Maryland Mortgage Program, they will give you 3, 4, sometimes 5% in seller and closing costs or down payment assistance. So their rate, though, is higher than the rate I would give you without a grant program by about 3/4 of a point, sometimes 1%. So it depends on the market at that time, but they're giving you money. They're giving you down payment so you can secure a mortgage. And if you have excellent credit, which usually you have to have about a 640 score to qualify for a MMP program. Okay. And again, we would have to do a pre-qualification on you, a pre-approval to see if you're eligible for the program and if you qualify. But again, this program is really an excellent program for fund assistance or grant assistance. They have a smart buy program. There's different programs within the MMP. And so you need to call me and we'll go over that. DC Open Doors, they have their program and they could take you on a 0 down payment because they will give you X amount first-time home buyer and non-first-time home buyer programs are eligible. But again, you have to see the maximum borrower income limit is 151, and that means with a family of 2, 3, etc. But again, we'll have to qualify you and see, and we have to also look at if funds are available at the time that you apply. FHLB is a great program. On here, we haven't changed this. First-time home buyers receive $12,000 in assistance, community partners, essential employees, retired law enforcement officers, firefighters, employees of the state, accredited schools, employee of healthcare, first responders, active duty military get 15,000 now. However, there's only $1 million allotment per lender that's eligible for the program. Not all lenders are eligible. We are eligible. Just as a caution, FHLB grant funds, and when we had it, it was such a hot commodity, all of it went in one day. So the one program that I say has been fulfilling for a longevity period of time is MMP. Maryland Mortgage Program is excellent, and they always have money. Virginia Housing has a program, VHDA, and they have their role. So there's a lot of programs, but again, you have to look at what you want. If you're using a program, no, the rate could be higher. There's certain parameters that you have to fall in to see whether or not you qualify. Again, all of this is determined in the pre-approval process, and all of that comes out, and that's why it shouldn't be a daunting process, because all of this is determined in a qualification pre-approval process. So next is student loans. I'm not going to go through everything on student loans except to let you know, about 4 to 5 years ago, the student loan situation changed from a qualifying standpoint. We used to have to use 1% of the balance of your student loan balance in order to qualify you. So in other words, if you had $200,000 in student loan, that's $2,000 that we had to use as a monthly payment, regardless if you were deferred or not. A lot of people see on their they might still be in school, they might have just gotten out and it's deferred for another 6 months. It doesn't matter. The guidelines say that we have to qualify you with now 0.5%, which is great. It used to be, again, 1%. So they cut it in half so you could qualify for these student loans. And the good thing about that is that it makes more people qualify for mortgages. There's another aspect of it, though. If you have a payment and the payment amount is less than the monthly payment reported on the credit report, and the lender must obtain written documentation. In other words, if you have documentation and the credit report says that you're paying $300 a month, however, you have a payment arrangement that says you're paying $50 a month, then as long as you have that documentation, we have to use the documentation from your student loan entity to qualify you. Income-based repayment plans are acceptable where that didn't used to be the case with proper documentation from the student loan company. It used to be that you had to have a payment that was fixed and amortized over a period of time. Now they allow you to have an income-based repayment plan, and that is huge because you can have minimum payments of $25 or $50 to qualify. So that's totally all you need to know, because VA conventional and USDA all use pretty much the 0.5 method of payment. Now, about credit scores. I don't cover credit scores. I can. I've given enough seminars on them, but you just had the best in the industry give you an overview on everything with regards to credit scores. So we come to the home buying don'ts, and that's how I conclude all my presentations, because this is the fact that you need to know, that even though we tell folks this, even though this is in all of my loan packages, you have to pay attention to it. Number one, do not change jobs, become self-employed, or quit your job. Okay? If you know that you have an opportunity to move on to another position and you're getting paid more money, give me a call up and I will certainly say, this is the documentation you need to get. Okay, get this documentation, get me your offer letter, let's see it, and you should be okay. Nobody's going to slight you for improving yourself and improving your family's position. Number two, do not buy a car, truck, or van, period. If you're in the loan process, you don't want to incur a debt of $500, $600, $800 a month when you could just get your house, then get the car. The security that you need right now is the house. Do not get something just to look fly and sit in the garage. That's not what this is about. Building wealth starts with being smart, and it starts with getting what counts. The house is what counts. Number three, do not use charge cards excessively or let your accounts fall behind. Number four, do not spend money you have set aside for closing. Leave the trip for Cabo, leave the trip for Vegas until after you close on your house. Trust me, we've seen it where people have gone and just squandered their money for closing on a 4-day or 5-day trip, and they're scrambling to find money because they've blown it just for just a couple of days, lost their mind and come back to reality, and the house is not theirs. Number five, do not omit debts or liabilities from your loan application. We find out everything. There's certain software that underwriters use that everything comes to the front. So just tell us up front so we can prepare you and know how to deal with everything. Usually if you do everything legally and honestly, everything is fine. Do not try to circumvent, what is reality by going around, and we find everything out. Number five, do not omit debts or liabilities from your loan app there. Just said that. Number six, do not buy furniture. It's like buying the car first. You're buying the furniture before you buy the house. Get the house and take your time. It's not going anywhere. You don't have to have us all furnished in the new car outside and all of that. Take your time. You have the most important thing, and that's the house. Number seven, do not originate any inquiries on your credit card. Again, here's a fact. Just a few days before the closing, just about every lender in the country will do a soft pull to see if there's any added debt that change your circumstances for qualifying for a mortgage. Just be aware. Number eight, do not make large deposits without first checking with your loan officer. Every time you make a deposit for $500 and above, you have to write a letter of explanation and provide us with support documentation to show where the funds came from. We have fiduciary responsibility to the bank. We have laws that we have to, federal laws that we have to follow. And so everything is paper trail. So it's critical that you understand that and you follow the rules. It's very simple. It's really not that difficult. Number nine, do not change bank accounts or move money from different accounts. Please call the loan officer, call me first. I'll be more than glad to instruct you what to do or not do. Okay? We have all your different banks. We don't need you to move one to the other. Just wait. Again, it's 2 to 4 weeks you're going to be in your house. Just follow the rules for that period of time. Number 10, do not co-sign a loan for anyone. It's not in your best interest to co-sign a loan. It's like buying a car. You're inheriting a debt that you really don't need. that could cause you not to qualify for a mortgage. Okay, this is one of those times you have to be selfish and it's about you and your family. After you get your house, if you still want to co-sign for someone, that's fine. But understand, once you co-sign for someone, if they can't pay for it, it's on you. Okay? So, with that said, I appreciate you guys being here tonight. My contact information is on your screen. Sean and I look forward to always educating the consumer base because they think it's something that needs to be had. You can't build wealth without first purchasing a house. That's how it starts. And you start by getting pre-qualified, learning about your credit, and going forward. If you have any questions, please feel free to ask any questions. I'll be more than happy to help. And if not, you're welcome to contact me. My phone number is right there, 571-278-8351. And Shervin.Joseph@FitzgeraldFinancial.net. I'm sure it's up on the Washington Informer site. We thank you for attending this evening, and we appreciate you. Take care and have a good evening.
Thank you. Good night.